Hello everyone, I'm Marty Pospisil and welcome to my May 2022 real estate market update for Vancouver. Just gonna have one sip of this great coffee and we will jump right into the stats. I've got a lot to cover today and some really interesting changes taking place. So let's get right to it. As you all know in my monthly updates, the metric I use to track how active the market is called the sales ratio. And all the sales ratio is the absorption rate of product into the market every month. So how much is selling out of 100? If 15 are selling out of 100 every month, we got a 15% sales ratio or absorption rate, and that determines how active our market is. So if less than 11% is selling on a monthly basis, we're in a buyer's market, it's favoring the buyers, and there's downward pressure on pricing. If there's between 12 and 20% selling every month, we're in a balanced market and it's not favoring the buyers or the sellers. But if we're over 21% sales ratio on a monthly basis, we are in a seller's market. There's upward pressure on pricing, there's multiple offers, bidding wars, all of that's taking place over 21%, and that's what we refer to as, of course, a seller's market. And it's the balance what determines the price fluctuations. So without further ado, let's jump right into our market speedo. We've got a great video here of a beautiful home. I wish this was my home. Look at that pool outside. Sorry, I digress. Mortgage rates and, of course, the fiscal tightening policy is impacting our lending rates. That's having an impact on our market. We're at 34% still sales ratio for Vancouver. That's still pretty strong. That's all product tied together in all areas. So let's break that down on my next slide in my table. But for now, we're at 34% compared to last month, we were at 50% overall. So we're still in a seller's market, but it is changing. And if you look at the total listings, of course, year over year are down. Total sales, of course, are down because we have less inventory. But sale prices, of course, year over year have dropped overall as well. So that's kind of an interesting stat. When we look across Canada, I just wanted to show you this slide very quickly. You can see BC here at the end has done quite well compared to the rest of the country, only outpaced by some of the maritime provinces. Quite interestingly enough, prices across Canada are up year over year, except for the Northwest Territories, which I found quite interesting. So that's just a Canada snapshot. Back to Metro Vancouver, let's look at the stats for houses. Year over year, the sales activity for detached is down 42%. The benchmark price from this time last year is up 21%, significant increase. But the benchmark price from last month has only increased by 1%. So that's a really interesting change because normally 1% would be a very healthy growth in our market. But we've been seeing 3.5, 4% in some months growth on a monthly basis. So this is a change. And then again, on attached townhomes and duplexes, year over year, we're seeing 40% less sales activity. Again, there's less product to sell, less sales taking place. That's no surprise. Overall prices for townhomes, half duplexes, are up in Metro Vancouver by 25% year over year. But last month, we only had a 1% increase in our benchmark price. Very interesting. Attached apartments and condos, year over year, activity down 26%, prices up 16%, and in line with the other product, we're looking at a benchmark price increase from last month of only 1%. Very interesting. So what's happening? Let's look at different product in different areas. Detached houses, Vancouver West Side, surprise, surprise, we are in now a balanced market of 14%. We've been seeing it in the front lines On properties we would normally expect to see 7 to 10 offers, we're getting 2 to 3 offers, and it's a lot more work pulling those offers in on each of these listings than it was just a month ago. So on detached houses, west side, we're at 14% overall sales ratio. Now some neighborhoods are still in a seller's market, but that's changing. You can see Kitsilano, Cambie, and Arbutus are still in a seller's market, but compared to last month, overall the west side was in a 21% sales ratio, so that's a drop in activity. Condos and townhomes on the west side still very strong at 39% sales ratio. We're seeing some very active neighborhoods, but that down from last month at 56%, a significant drop in activity. And if we go to condos, townhomes downtown, you'll see they're at 30%, still into a seller's market above that 21%, but compared to last month, we're down from 42% to a current 30% sales ratio for downtown. Detached houses on the east side. Remember, the last month we were at 40%. We are now at 23%, barely into a seller's market for the east side. Again, we've got a few hot neighborhoods like Fraser, Hastings Sunrise, Knight Street area, Main Street area, still quite hot, and overall 23% houses on the east side. Let's go to condos, townhomes east side, still very strong at 53% sales ratio. That's a hot market. But last month we were at a crazy 75%. So even the condos, townhomes on the east side have settled down a little bit, but very strong still at 53% sales ratio. Multiple offers, hot market on the east side for attached condo product. So let's see what's happening in the burbs. This sort of tells the bigger picture throughout the Lower Mainland. And if you look at detached monthly variances from last month, what's the sales ratio doing in all of these suburban neighborhoods? And you can see they're all red, and I almost missed it. There's one that's green. Everything's dropped in terms of activity except for Pitt Meadows. Surprise, surprise. Must be affordability, a little pocket in there where we're still seeing hot activity and the sales ratio going up. But overall, they're almost all down for detached houses throughout the Lower Mainland. Attached is completely red. You see all the red down arrows, all the sales ratios, and all those areas compared to last month has dropped. So we've got 100% cooling off throughout the Lower Mainland. So this is very interesting. We're starting to see some trend here. From a forecasting point of view, you know all the metrics that I've been watching on a monthly basis to determine where a market's going. There are really 3 drivers that we look at. There's consumer confidence. So as I alluded to earlier, the buyers are getting tired of competing. When we're dealing with offers on listings, they're saying, well, if there's other offers, my buyers just aren't interested. We're having to work very hard to get those offers in. They're worn out from being outbid on various properties, and they're walking away from homes that might generate multiple offers. We see it every day. The next factor or market driver is, of course, the cost of borrowing. Now, you all know the rates have started to increase dramatically. We'll get into that a little bit in more detail later when we're talking about inflation, but that is impacting the entry-level buyers, which feed the entire market up. And even though upgrade buyers, people going from townhomes to houses or buying larger houses, most people need a mortgage, and there's been some giant increases in lending rates, making it very difficult for some of these buyers. So the cost of borrowing factor is also causing this slight cooling off of the activity. The biggest factor, of course, is inventory levels. We're still at a 30-year historic low. There has not been any dramatic increases in inventory, but you'll see there's been a gradual increase over the last 4 months. We'll look at that. That's the last major market driver that if that changes, then we're going to see some dramatic changes in our market. Consumer confidence, let's talk about that first. consumer confidence overall has actually started to fall, which is very interesting. Business confidence up. Post-pandemic employment is up. That's good news. People are all back to work. Unemployment down. And retail sales, of course, are up. If you can find something to buy, we'll get into that. And that ties into consumer price index later. But tourism, there's our pre-COVID levels prior to April of 2020. You can see we've just started to take off last summer. It's been a little bit of a jumping around, but we're nowhere near the tourism that we had pre-COVID. And that does employ a lot of people and does impact our entry-level market as well. Cost of borrowing, the elephant in the room. Let's talk about that. Why are the rates increasing so much? Well, the consumer price index. I was talking to a builder client of ours just the other day, and he told me that the cost to build a new home is hovering around $400 a square foot. Significant increase from where we used to be. I remember not too long ago it was $250 a square foot. So we've seen some big increases in the cost of materials. Not only that, also in labor. Drywall. We're looking at framing, wood, we're looking at roofing materials. You couldn't even get drain tile in Vancouver for the last 4 months, but now that's starting to come in. But the consumer price index, the cost of all of these goods has increased dramatically because our supply chains have, of course, been affected from the pandemic. Now that, of course, results in hyperinflation. The US is at 8.5%. We in Canada are at 5.7%. Now we like to see about 2%. That's what the government likes to see annually for inflation. If we're at 5.7%, we're actually at a 30-year high for Canada. Not good. It's just not good to have that situation. So the Bank of Canada has really two options when it comes to high inflation. We can allow the demand to continue running hot and wait for the supply chains to recover, trading off wage and employment gains for slightly higher inflation. Or we can do what we call tightening the fiscal policy, and we can raise the interest rates, which in turn lowers the demand and eases inflation. And that's referred to as tightening, and that's what our government's doing, and that's why we're seeing these big jumps of 0.5% in order to get inflation in check. We would like to see that come back to 2%. We being the government, of course the consumers as well. It's just not good when it gets this out of control. So that's why our interest rates have been going up, and they're going to continue. It looks like we're going to see some more increases. That again will impact the market from the entry level all the way up as the rates continue to increase. Inventory levels. Now this is the last bastion or driver that has not reacted dramatically yet. We are at a 30-year low for listings in BC and Vancouver. Of course, normally we see 40,000 listings for sale at any given point in time. We're about 25,000 listings below what we should have, and that is keeping the prices up. There's just not enough product to buy, and there's been quite a high demand. So that's province-wide. We like to see it up here on average. So let's look at more specific in Metro Vancouver on the west side. If we're looking at detached houses, the red line is inventory. So you can see our inventory has been building since December of last year. 455, 500, 534, 575, 658. We are seeing that inventory of houses start to build in the west side, but nothing dramatic like we've seen in the interest rate changes. Attached product on the west side, condos and townhomes, same story. You can see from December of last year, we've seen the inventory starting to build, but again, nothing dramatic. There's going to be some kind of trigger that may come that will cause more people to list. Hard to say, but that's a very big driver in our market, so we're watching that closely. Residential prices, of course, we're at the highest prices in history. If you look at my favorite graph, it's the average price graph For Greater Vancouver, you can see the average price for a detached home in Greater Vancouver is $2.311 million. For a townhome is $1.195 million, and you can see these are, of course, the highest they've ever been. But look at if you can freeze this video and zoom in on this particular data point here, you can see the prices have actually dropped for townhomes and half duplexes. And of course, condos are at $841 average price. So that's quite interesting. Where is our market going? Let's look at the factors that I've been following every month. This is, of course, our housing price index for Metro Vancouver. And if you look at the various factors that have impacted our market, we can see provincially, our government has introduced the BC cooling off period. So buyers will be able to walk away from transactions even if they're subject free after a period of time. That's certainly impacting our market. We've talked about the interest rates, the way they're going now. That's certainly a negative impact on our market as well. The federal government has announced two programs. Number one, a 2-year ban on foreign home buyers. That's interesting to try and encourage more local buyers and keep foreign money out of our market. That might have been fueling it. The stat is actually it's less than 1% of our market, but still they're trying to quell that gasoline that was being thrown in our market. Not really impactful today though, because we don't have a lot of foreign home buyers. They've also introduced higher taxes for individuals who are selling their home within a year. So if you're buying a home and selling it within a year, they're looking at that more of as an investor, not a homeowner, so they're going to be subject to some higher taxes. Consumer confidence is falling. People are getting burnt out. They're getting tired of the bidding wars, etc. And they may not be spending like they were, especially when we're seeing these interest rates rising. So that's a factor. These have all happened. Blind bidding, they're talking about doing. This is the big one that is left the listing inventory surge. When that happens, we're going to see some dramatic adjustments in price. So overall, you know, they say they don't toll a bell when the market hits the top, but I'll tell you, I've got my little bell here and I'm going to ring it or toll the bell. No one can tell the future, but we may very well be at the crest of our market. And if we continue along here, a little bit of good news. I thought I'd include this slide. I found it quite interesting. Global greenhouse gas emission chart. Now, prior to 2015, the world was expected to warm by 4 degrees. But of course, with everything we're doing, the solar power, the wind power, all the electric cars, all you people buying those Teslas, good for you, that has helped increase our optimism, because with the current commitments, the planet would only warm by approximately 2 degrees. I thought this was kind of good news. We've got to be on it because this is kind of important. Real estate means far less if the planet we're living on is in trouble. So we've all got to do our part. I thought I'd include that very interesting stat. That is my update for May 2022. I'm Marty Pospisil. I hope you enjoyed that. Subscribe to my YouTube page and like us on Facebook, and I'll keep you up to date on a monthly basis. Take care, stay healthy, and enjoy May.